All right, guys, welcome back to Basics 2. If you missed the first one, just go back on the channel. But essentially, what we're doing is we are taking my beautiful fiance Jessica here, who is interested in learning about investing in the stock market and all of that, and we are teaching her the basics. And then from there, you're going to go off to your own YouTube channel and document your journey to riches or ruin, which I think will be lovely. Last time we basically just started with an introduction of ourselves and what we were planning on doing. So this is like the first lesson. And as you can see, it's called What is a Stock? And then we're going to talk about exchanges. So, what's a stock?
It is like a piece of a company you can buy.
That's actually a pretty good answer. So if I say, I was bragging about this Beyond Meat trade I had. So when I say I bought shares of Beyond Meat, what do you think that is and what do you think that gives me?
It gives you a piece of the company. A very small, well, it depends on how many shares you have. The more shares, the more pieces of the company you have.
Exactly. So there's a handful of things. So the first is we have watched... went forward. This is how you find us. So if you're seeing this on my channel, go check out Jess's. And if you're seeing it on Jess's, come see mine. So this will be the documentation of a new trader and how they learn. And I'm more of a algorithmic quantitative trader. So if you're a nerd, if you're starting out, go see Jess. So we've watched Shark Tank a bunch. We have one up in here, Canada. We call it Dragon's Den. Essentially the same thing. So we've seen this a bunch, right? Someone walks on and says, I have this idea. I want money. So there's two ways that a company can get money. One's debt and the other's equity, right? We all know what debt is, unfortunately. Equity is basically I am going to sell part of my company to you. So as the investor, one of the things that you're going to say is this company, A, is it run well? B, does it have any sort of growth in the future, or is it tapped out where it is now? And then, C, how can I get out, right? So you've owned a couple businesses of yourself. So imagine if you tried to sell those. What would you do?
I'm not sure.
So that's the point of the stock market as a whole, right? When you're just pitching to, Mr. Wonderful or these guys like that, you have to find someone and then you have to give them the whole value proposition and what are they going to get and what are they going to buy and what are they going to sell. But when you go to the market, you basically have an exchange of people all the time looking to buy and looking to sell stock. So that's what an IPO, which we'll go over in a public exchange, that's the point of it. It's liquidity. It's the fact that if I want to buy Apple and then a minute later, a month later, a week later, a year later, if I want to sell it, there'll always be that ability to trade. Where if I open my own candy shop and I sell half of it, and then that guy then wants to go and sell that half to someone else to make a money, then no monies.
Make
right?
money. A single money.
A single money. One single money. So this is just some vocabulary, but so you'll be using trade ideas as your order entry. So essentially what happens from there is we're going to use a sim to start with, but this is kind of what happens in the real world. So it starts with whatever your order entry software is for you. So for you will be trade ideas. There's a handful out there. I'm biased, but I think trade ideas is the best one. Then it goes to your stockbroker.
You're like the British guy.
Well, that's the British guy you just heard is actually my stockbroker, which is Interactive Brokers. So what they do is they manage the money, right? I give them the money. They manage all that. I don't have to, actually go out and pay money every time I want to buy a stock and receive it back. They handle that. I have here AML and KYC. That's basically just a rule to make sure I'm not a terrorist. And you've seen Ozark. That's money laundering, right? They do the check to make sure you're not using their exchange to launder money. And then they push your order through the exchange. And what the exchange is that matching that I explained earlier, right? So the New York Stock Exchange has your big, slow type old companies like Macy's and Walmart and these type of things where you can go and you can buy and sell, but every time you push the button, it goes through this kind of chain of command, right? It goes from your broker or from your software to your broker to the exchange and then back again, right? So we are trading the equity markets, and we'll go over it later. There's a whole bunch of different markets, but we're going to be trading the equity markets primarily, and that's what we talked about with the Dragon's Den, where you're basically trading a bit of the company. A couple things that gives you: it gives you voting rights, which you'll never use, right? We're in and out, but you could, in theory, go and vote for the next CEO of Apple if you own one, right? But you'll get one vote, and the guy next to you will get 1 trillion votes, and then usually the CEO of Apple the most votes.
Here's a question.
Yep.
Why? This is one thing I've never understood. How can if a company is at 100% whole, how can someone buy more than, like, how do these shares get divvied into further than 100 pieces?
Well, what happens is, so one of the companies I own, I already started with it. There's 1 million shares of the company I own.
But how?
But that's just because each share represents 1/1,000,000th of the company. It's just, if you think of a pie, just all about how you split the pie. You could split it into 2 shares, or you could split it into 1 trillion shares. But it doesn't matter. It's all about percentage ownership.
Okay.
And when you go to the
sense.
market and you buy a stock, you're not buying it from the company. You're buying it from another trader.
Yeah.
So the company IPOs first. And what they'll usually do is they'll say, okay, we need money as a company. So Facebook, for example, right?
Yeah, so then they decide they're going to sell X amount of shares, and their starting price is their IPO, isn't it?
Exactly. And then
Oh,
I'm impressed.
I should be teaching this class, actually.
So in the beginning, they launched those shares.
Right.
Now, the company theoretically doesn't care about the value of those shares anymore, right? The only reason they care is if they need to raise more money. So what they'll do is they'll go out and say, okay, we did our IPO. That was 1 million shares. We raised $50 million by doing that. We need more money, and we don't want to go to the bank to do it. So sometimes they'll issue more shares.
How do they do that?
What they do is they screw all the existing investors. Because if you started with 1 million shares, right, and you own 10% of the company,
Okay.
and they dump another 1 million shares in, you only own 5% of the company now. So companies only do that if they're like really hard up.
I don't understand.
So I IPO Facebook, and I IPO'd 1 million shares. I think it IPO'd at $50, right?
Okay, when they IPO'd at 1 million shares, is that like, where are they getting that million, like, as a whole of Facebook? Is that all the shares Facebook has, or is that like 50% of what Facebook has?
It's most of what Facebook has. So like Zuckerberg has a chunk, right? He kept a chunk of shares. And there'd be a handful of people out there who invested in Facebook in the early days, and they were given shares as well.
So let's say they're holding on to, they're not, the market will never see 50% of Facebook's shares. Does that make sense?
Right. And, you know, unless Zuckerberg thinks that the whole thing's going down and he has to sell. And that's something that we track in Trade Ideas and we'll watch for, is every time someone who owns a large chunk of a publicly traded company sells, they have to report that. So if Zuckerberg ever sold that 50% stake or whatever he still owns, the whole world would know about it right before it happens.
Got it.
By law. And then, right, you'd obviously
And then
go...
everyone else would sell theirs.
You'd always go with what, because he knows more than you know about Facebook, right? But no, it's not the entire float. It's called, all the shares out there is just called the float. It's not the entire float, but it's the entire float that they want to give to the public to raise money.
Okay.
And what they do is they decide on how much they want to give based off how much money they want to raise. So what they'll do is, you know, so on Dragon's Den, they walk in and the guy says, okay, I want $1 million for 10% of my company. And then they go, so you think your whole company is then worth $10 million, right? So what they'll do is they'll say, okay, I want to give away half of my company into the market, and my company's worth $1 billion. So I want to make $500 million in cash from that initial sale. Then the other half is usually, again, it's going to be Zuckerberg, and it's going to be, Tim Ferriss, that I've got a bunch of his books. I think he did something with Facebook early. He had a bunch of shares. But that's the way that these people sell. So if you invest in, again, someone comes into the Dragon's Den, you invest in early, you get 10% of their company, you're hoping that company IPOs way over $10 million, $20 million, because now you have this open public market that you can just go and sell your shares to.
Right.
Right.
Gotcha.
So that's usually IPO is like the exit plan for the early investors and to raise money back in for whatever it is that you want to do next.
Got it. Now, going back to what you were saying before, like, so say you bought these shares at whatever price they were when the company first IPOs. If you buy these shares, where do they get the other shares? Like, once those shares are gone, like once everybody owns those shares and they want to raise more money, where are they taking them from?
They make more. So then every share out there is worth half as much if they double the amount of shares. So it's like how the government prints more money.
Yeah.
But why would they shares?
But okay, but like wouldn't your people be mad?
Very mad.
Okay.
Very mad because again, I went from owning 10% of Apple
right.
to 5% of Apple. So it begs two questions. Why does Apple need money, right?
Yeah.
You know, why can't they go to the bank and get money? Why can't they use cash reserves, whatever? And B, why is my ownership decreasing? So they get really mad. So a company will tank usually if this kind of stuff starts happening. But again, it's more about they just want that initial in and out, and then the rest of it just provides liquidity. So the other thing the market does, it gives an accurate representation of what the value of that company is at any given time. When you're in the Dragon's Den, you negotiate what the value of the company is, right? And the market is doing that all the time. So you can look up and you can say, okay, Amazon is $1 trillion company. It's worth $1 trillion right now. If it doubles, it's worth $2 trillion. But the market is deciding the value of the price. No one has to guess on the value of Amazon anymore. It's no longer a negotiation in a boardroom.
It just is.
That negotiation's taking place all day long. So yeah, that's right. That's most of that. This is what the exchanges do. They deal with all the government regulation. They deal with counterparty risk. And counterparty risk is basically if I'm trading to you, you're the counterparty. So it's to make sure that all the trades go through, right? That if I'm selling shares, that I own the shares to sell. If I'm buying shares, that I have the money to buy. You don't have to think about any of that because the broker and the exchange do all that for you.
Okay.
Right? If you've made it onto the exchange with your shares to sell, it means you went through that order execution into your broker and then onto the exchange. So it just makes it so that you can trade. This is why you can see, over here of all my trades, I've done like 30 today, right? Because there's this active marketplace. So then this looks a bit confusing, but this is the stock market. I don't know what stock this is. I just grabbed this off Google, but essentially,
I know what these are.
What is this?
The MMID. I'm not sure what that stands for.
Yeah.
But that's the company.
No.
Okay.
Close.
Oh, those are the exchanges. There's NASDAQ. There's the NYE.
Right. Yeah.
Got it. Okay. And then the bid is, I'm going to say, okay, so I lied. I didn't know what it is. I assumed what it was and I was wrong.
So think of it like eBay, right?
Okay.
So everybody thinks of the market as, sorry, I just kicked my dog down there. Everyone thinks of the market as the last traded price, right?
Okay.
But the market is always what someone is willing to buy it for and what someone is willing to sell it for. And a trade only happens when those two meet. So right now, in whatever stock this is, people are willing to buy. And you're right. These are all the people across the exchanges. And under size, these are all the people, how much they want to buy or sell, right? You have to multiply it by 100. So the top one is someone wants to buy 4,700 shares of whatever the stock is at $34.95.
Got it.
That doesn't mean he's going to buy it there. That's what he thinks the value of this stock is worth.
Wait, what? Okay. So what are these exactly again? They're MMID, what does that stand for?
I don't remember. But it's basically different ways into the market.
Okay.
So the exchange kind of takes all of these quotes and it aggregates them and it puts them all in one place, right? But these are different ways that you can get into and out of the market, and you'll never need to know this, but different ones have different benefits. But again, you'll just click a button and you'll get filled.
So now this is a newbie question. I thought when you like opened your trading, like you're only trading on like one market. Does that make sense? What I'm saying?
Yes. So all of what you see here. So say this is Macy's, right? And I just
What's
use that.
Macy's?
We'll just say that this stock. So this is a stock that you're looking at.
Oh.
Right? This is a stock, and so say this stock is Macy's, right? Basically what it's saying is there's all these different ways to buy Macy's, but they all lead to the New York Stock Exchange where Macy's is traded. They're just different ways into the exchange based off where you are and how you want to get your order filled. And again, it's stuff that you'll never care about. It's only important if you're trading like 1 million shares of Macy's.
Okay. Well, why isn't that important if like I'm looking at the NASDAQ number, which is obviously way higher, the size is way higher than anyone else's. So why wouldn't you automatically want to go in and sell your shares there knowing that more people want it there?
Because the exchange, it's all the same price, right? So you're going to get the same price regardless. And the exchange will do that for you. So the exchange does what's called a first in, first out. If I put my order there first, and everybody else, including this NASDAQ and everything, comes in behind me, I still get filled first. And same with the other way out. It has to do with like very minute fees. They're all of these guys charge a very different fee to get in and out of the market.
Okay.
So if you're trading in and out like 1 million times a day, you're going to always want to look for the one with the lowest fee. Or if you're trying to get filled quickly, you're going to find the guy who's most vacant and you're going to put your orders there. But this is like what I did back in college. This scalping, this is all done by computers now. You will never see this screen in your trading, basically.
Okay.
Right? It doesn't matter anymore. It mattered back in the day. Now it's just two computers fighting all day long. But what is important is this concept of a bid-ask spread, which a lot of people, especially newbies, don't get. They think, we're looking at Constellation Brands over there, the last print was $37.18. A lot of people think that they can just go get that. They can get that price because that was the last price that happened. But the way the market works is this. So again, think of it as eBay, where the bidders, these are people saying, I am willing to buy whatever, this for $1, right? Or to make it $34.95.
Right.
And the people on the other side are saying, I'm willing to sell that for $34.96. So if you want this stock and you want to go in and you want to buy this stock right now, what are you going to pay?
$34.96.
Right. And if you're trying to sell that stock, you click the button and you buy and you said, oh shit, I didn't mean to do that. And you want to sell right away. What price are you going to get?
$34.96.
95.
What?
Right? Because these people are looking to buy and these people are looking to sell. So if you come in as the other side and you're looking to buy, you're going to buy one of those guys' shares.
Right.
And if you're looking to sell, you have to sell to one of those guys.
Oh, I see.
Right? So they're posting.
Yes.
So now this is what we call a very tight spread because only one penny wide.
Right.
Right? If the stock is something that's not traded very much, it's like a boring stock that no one knows about, that spread could be
a
like
lot bigger.
Dollars.
Okay.
Right? So it's important to know just because the last price happened doesn't mean that's the price you can get.
So what's the deal with the red and the yellow and the blue?
Those are people below the market, right? So
or above the market.
Or above the market. So this guy's looking to buy at $33.72.
Okay.
And then below that, there's a guy trying to buy at $33 or $32.01. There's usually more in there, but they hide their orders. Again,
But you never see this.
You will never see this. No.
Okay.
What you'll see is in Trade Ideas, you'll see the bid is $34.95, and then it sums up all of those numbers into one and says if you're trying to sell, here is all of the liquidity out there, and if you're looking to buy, it sums that up as well.
Okay.
That makes sense?
I think so.
So that's the basics of the market. So when someone says the stock price is this, they're never talking about this. They're always just talking about what's the last trade that happened. And again, if people were hard locked at these prices, there'd be no trading.
Right.
Right? It's only when somebody disagrees.
So so let's say you have whatever stock. Let's say you have Apple.
Yep.
And you're holding on to it. And somebody wants to buy Apple. Well, though, I guess you would just, if you weren't willing to sell it at what they were bidding for it, you just would hold on to it?
Yep.
Or take the loss.
Right.
If you wanted to get out.
Well, exactly. So if you bought this stock, you only show up on this screen when you're looking to sell. So again, Constellation Brands, just because it's right up there, I bought some shares earlier today, and it's had a nice run up. Well, so what I've done is I've thrown an order out way out of the market. So that means if I'm doing something else and the stock runs up a bunch, I'm waiting there in this area. And the reason I teach this is because, again, it talks about that spread. Some people say, oh, I started to trade and the thing was trading at $34 and I got filled at $35.50, right? And it's because of that spread. And then the other reason is it's all about orders. So if you want to get into this stock now, you want to pay $34.96. But if you want to be cheap and you want to try to sneak another few bucks out of it, you can put an order out there at $34.90. And if the stock moves down a bit and they get you, you're waiting there in line. So my order for Constellation Brands is about $1.50 away, but it's already out there, which means I'm one of the first in line. So if it comes up to that price and only does a little bit of trading there and then drops again, I'm almost first in line.
Got it.
Right? So, and again, we'll go down the road, but it comes when you're using
stop loss orders. Can you retract that? If you put an order out and then okay.
And that's, again, we'll get into high frequency trading and all that, but there is robots that all day long will mess with this. So when I started trading, this was real, and we would use this to trade. I would try to get in front of this NASDAQ guy, and then I'd put out an offer over here for a couple cents higher because he's really big. And if he started to go away, I would get out, right? So that used to be a game that you could play, but now these robots will just flash.
Is that sized as how many shares they have?
Yeah. So that guy's trying to sell 18,000 shares.
That's a lot of shares.
Right? So what I would do is I would buy $34.96 and then I'd try to sell it like $34.99. And if that started to go away, right, people started to sell to him and it started to go away, I would get out. But you can't the robots took that over. You can't do it. They're just faster than you'll ever be.
Oh, we'll see.
We'll see. Order types. Right? So these are important. We'll go deeper into these right before you start trading, but just, an introduction. So a limit order is buy me at this price or lower, right? So a limit order is back to the screen. So if you put in a $34.90, you will get $34.90 or lower. You'll never pay higher than that.
Okay.
Right? If the market moves real quick, maybe you get filled a little lower. But that will be it. Now, if you put out a limit order for $34.97, right, you're saying give me $35.97 or lower. And since $34.96 is there, you'll get filled there.
Okay.
Right? These are 90% of your orders will be this order because you can get in aggressively and you can get in passively with these orders. A market order is get me in or get me out. I don't care what the hell the price is. This is like their holy shit button.
So this is just like gambling.
Kind of.
Pretty much. I'm betting it's going to go up. I'm betting it's going to go down.
But instead of the statistics against you, we're going to teach you about backtesting and basic statistics and all this. The statistics will be on your side. And unlike gambling, you can take your chips off the table at any time. Right? You're not... You put your chips down, you get the first card on the flop, and you say, no, I don't want to play this game anymore, and leave. You can't do that in gambling. You can do it in trading. At any point, you can just say, I don't like it anymore. I want out. And then if the second card turns over on the flop, you can sit back down and say, maybe I want to get back in here, right? So more flexibility like that. So again, the market order is your holy shit button. I want in or I want out. I don't care the price.
Okay.
Dangerous.
Well,
because that wide spread, right? So if, say the spread was $3 wide, or say this was $30.95 and this was $40. If you hit the market order, you're paying $40 And then if you have to turn around and get out, you're paying $30, right? Because you're saying any price. So if the spread's really wide, you're going to get hit on both sides.
Right.
But if the stock's moving quickly and you need to get out, this is going to be your fastest way out.
Okay. So let's say the spread is $10, let's just say. But you think, what do you mean you're going to get hit on both sides?
So with a market order, what you're doing is you're saying, I want to buy, I don't care what the price is. Send out an order, the closest order, give me that.
Right.
So if the closest order is really far away, then
that's what you're going to
get.
But, okay. But sometimes that's okay. If you think for some reason that this stock is going to skyrocket and you want in.
Right.
So you pay that, but you're not necessarily getting burnt on the other end if the stock doesn't tank.
Right. But it just means if you have to then get out, you automatically are down $10. If you have to get out quickly.
Okay.
Right? So that's why this is your holy shit button, which is you're in a stock and the stock's tanking against you and you need to get out quickly. You just send a market order because you just need out. You don't need to haggle for prices or anything. You just want out. Right? Okay. And that's what we'll use that for. And then the next is a stop loss order. So you can use these to buy, to enter, or exit. So, for example, say I was long this stock and I wanted to get out if the price gets to $34.89. That's I want out then. And right, you're going to take a trade and go to your job and then 2-3 days later close it. So you want to make sure that while you're there, if the stock tanks, you're not in. So that's an order that says if it gets to $34.89, get me out.
What do you mean I'm going to leave it for 3 days?
You're a swing trader. It's going to be...
No.
Okay.
I want to make $1 million in 25 minutes.
Yeah, I have a few YouTube channels you can watch that will tell you that it's possible. But yeah, your stop...
Well, tune into mine later. I'll be on the same boat.
You can also use
the millionaire boat.
Yeah. Well, I get half, so that's fine with me. So the stop loss order, and we'll show charts down the road, but so I put in on this CNST, it had this really tight, the price was just oscillating this really tight base. And I said I wanted to get in if it broke above that. So I can put a stop loss order to get me into the trade, not just get me out.
Okay.
So I put in something, I said, if it breaks out of here, I want in. And then again, I can go and I can do other things or watch other stocks or whatever. And I just know that if that breaks that price, I'm in. So,
and you'll get that British guy.
Well, that's usually what you're hearing. Yeah. Settlement, pattern day trader rule. We're Canadian. Doesn't apply to us. This is more just for them because this is a basics type of thing. In the U.S., they don't believe you should be able to do whatever you want with your money. If you don't have $25,000 of extra money kicking around, you can't day trade. You can only do 3 day trades a week. And it's because if I buy a stock, by the time all the brokers do all their paperwork and everything to say that I'm the one that owns that stock officially, it's 3 days, right? Now, it happens quickly, so they have a good idea. But for everything to be like dot the I's, cross the T's, do all this, takes 3 days. So in the U.S., they make sure that you that settles, and it's.
Wait, what? Say that again.
Sorry. No. So in the U.S., and this doesn't apply to us here, they put this really dumb, useless rule to say if you don't have $25K, you can't actively trade. Okay. So you have to buy the stock. You have to wait for them to confirm that you have the stock, which takes up to 3 days. Before you can sell it. You can do 3 of these quick trades a week and that's it. And it's a horrible, it's a rule that may have made sense 100 years ago, but again, doesn't apply to us. We can start with any amount of money. Canada said.
But how does that affect the market?
Not the people that have less than 25K aren't really moving the market anyway. All it does is it hurts the little guy. Helps the banks, helps the brokers, it hurts the little guy. It hurts the guy who, you're young or you just haven't saved up 25K, which is, most of the world. It just hurts that guy. He can buy a stock and then he has to hold it for a week or two and then sell it. So again, it's for you guys out there. I just put two ways around. There is offshore trading where you can open up accounts offshore. Be very careful. And then a prop firm where you basically go in and you interview, and if they think you know what you're talking about enough, they will give you their money, and then there's usually some sort of split, right? If you will give you 50% of whatever you make or whatever. That's a way around this rule.
So that's what that's where the real game is, isn't it?
That's it. That's the...
Follow my journey on Jess's opening an offshore trading account.
No. No. All right. So that's it for this one. Again, follow us, both of us here. We'll keep doing this kind of stuff as long as people keep liking it. And then when you're making millions, you'll be doing that on your own channel, and you'll take a picture with your Lamborghini, and then you'll gain like 1 trillion followers. That's how the internet works, right?
Well, hey.
So, okay. Goodbye.